Hey guys, it's May from Markets with May, and in this episode, we're going to talk about why did my super safe conservative bond portfolio lose so much money last year? Now, I wanted to make this video because this particular product is primarily focused on folks that are either closing in on retirement age or are already retired. And for some of you, there's health issues which do not allow you to go back and remake that money in the marketplace. Now, I'm not here to talk about whether or not somebody did something wrong per se. That's a totally different ball of wax. But I do think that the industry as a whole owes you a clear, understandable explanation about what happens. Hopefully, this video helps you understand what happened so that you can have a more thorough conversation about what to do with your assets next. Now, in this video, I'm going to talk about three different things. First, I'm going to address what might have been said to you and what conceptual nuances might be missing from that explanation. Second, I'm going to talk about what actually happened in a bit more detail. And finally, I'm going to talk to you about different ways that you can think about what to do next. Now, I really want to make sure you hear me on this disclosure. Past performance is not indicative of future returns. This is not investment advice. This is for educational purposes only. If you happen to be one of the people that's impacted by this, feel free to send this to your financial advisor to have a more thorough discussion. I personally have no exposure to these indices or ETFs. Finally, I always give a shout out to Gurula.app. Money goes where it's treated best. And if you're curious about them, feel free to have a look at my show notes. Now, let's get into what happened with these bond ETFs. Now, when you called your broker sometime probably in the middle of the year when this asset class started to lose about 5% of its value, you probably engaged in a really fancy conversation about duration where your broker said something like, oh, don't worry about it. This is what we want to happen. These bonds are going to roll off and the new bonds coming in are going to be of a better value. And your gut told you that ain't the right answer. And then for the rest of the year, that bond ETF continued to lose 5-7%. And that's left you fairly upset because neither do you know what to do about it, nor do you want to call your broker and have another conversation about duration. Well, let's talk about the concepts he might have missed in there that are fairly important. Now, the things he got right had to do with the idea that duration is a measurement of time on the bond. So 1 year duration, 3 year duration, 5 year duration, a bond that is fully paid off in a year, 3 years, 5 years. Now, what some young brokers just missed is that duration isn't just an attribute of the bond. It is actually a type of investment risk that anyone investing in bonds needs to understand. Now, if they're really smart, then they would have also mentioned that the duration risk of a bond, a single bond in and of itself, is very different from the duration risk of a fund. Now, to make this significantly more understandable, I'm going to use the example of a house. If you bought a house in 2008 at the height of the worst time to buy it, then the house you might have paid $100,000 for. And maybe you were able to rent it out, and netting every cost out that you had, you got $10,000 a year in payments. And so that's 10 divided by 100, that's a 10% annualized return. Now, as anyone with a little bit of gray hair knows, as long as that tenant stays in place and pays the $10,000, it actually doesn't matter what the home value falls to. So let's say, worst part of 2008, that thing goes from $100,000 to $50,000. Well, in that case, you have a paper loss of $50,000, but you probably, as an investor, don't care as long as your tenant keeps paying that $10,000 a year. Duration risk has to do with that part of the bond that fluctuates. Credit risk is going to look more like that tenant and whether or not they can pay you back. And with these aggregate ETFs, typically you were put in one of the safer ones where there isn't any kind of risk to the tenant paying you back, but you definitely still had the fluctuation risk of the principal component of the bond. In other words, the house moving up and down in value. Now, in the case where you own the bonds outright, that's like being a homeowner. So you own that house, you're going to sit there and bear that paper risk of it moving up and down from $50,000 to recovery to $80,000 and so on and so forth. And as long as you don't sell that house before it hits $100,000, you're in good shape on that because you're only taking a paper loss and it sucks, but it's not the end of the world because you're still getting your 10% coupon from the tenant that's hanging out in the home. So if you owned individual bonds in your portfolio, that's what it looked like to you. The principal component of the bond fluctuated in price, and your broker had to take marks associated with that fluctuation, but you still kept getting the coupon payments, and any bonds that rolled off and were paid in full because they put you in good stuff, not high yield junk stuff. But the principal rolled off and they paid back the principal, and then you had cash. You were okay more or less on that portion of your book on what was happening. But the bond ETFs actually have another little nuance to it. Now, if you had a bond fund, and particularly if your bond fund had a component that forced a certain duration, so it's a 1-year bond fund, a 3-year bond fund, a 5-year duration bond fund, then what happened is actually a little bit different. See, one of the things that a bond manager has to do is they have to maintain the duration a certain way for the portfolio, if that's a part of what you've asked them to do. And what that means is that the average age of all the bonds has to come out plus or minus 1 year, 3 years, 5 years. See, what that means is that the bond portfolio manager does not get to hold that bond until you get the principal back. Instead, they have to eat the mark. So the nature of duration risk for them is ever so slightly different. Now, to drive this point home and make it crystal clear, let's go back to the example of the house. Now, as many people who lived 2008 know, housing prices didn't just fall in one fell swoop. They fell, then they fell again, and then they continued to fall for a period of time. Now, what the bond manager has to do is maintain that duration. So they have to buy into the market that they don't want to buy into. So they'll sell that $100,000 house at whatever price they can get, let's say at 80, and then they'll reinvest it in another $80,000 house, which then goes down to 70, and so on and so forth. So you're still only getting the $10,000 in rent per year, but you're still having it fall and fall and fall, and all that's happening is your bond manager is taking every single one of those marks. But then second little nuance about the bond market, remember, I told you if he'd been allowed to hold it to maturity, then he would have made back the principal when the company paid back the principal. But instead, he just kept reinvesting it into maintaining that duration. So like a 1-year duration bond, he, instead of just letting the principal expire and get the cash back, he had to reinvest it in something else that was going to still drop in value, and then still not be able to get the principal on it, and so on and so forth. That's what you probably experienced in your bond ETF. Now, a couple little questions that I know that you're going to have right away. Why doesn't he just hold cash? Well, it turns out that some bond managers have a little bit of wiggle room to hold more in cash, but most bond portfolio managers do not have that. Additionally, what the industry will tell them is that if you're holding cash and I'm paying you to hold cash, then that's a very expensive form of holding cash, because the expense ratio, the load, all these other fancy words that people tell you to look at, those are true too. So now let's talk about what exactly happened last year that made this more accentuated.
Last year, to stave off inflation, the Fed increased interest rates by 4.5%, which is by itself a large increase, but it was also the pace at which that increase occurred that made it particularly problematic to bond funds.
Now, normally, this movement would be very small, and you would barely notice it relative to the coupon payment that you're receiving. It would be as if you normally owned a home at $100,000. One day it's maybe $98,000. One day maybe there's someone that would give you $103,000 for it. But unfortunately, last year we had a very large increase in interest rates. So in other words, for the bond managers who have this fixed duration mandate, every time the duration would dip below where they were allowed to have it, they would have to go to the market and buy bonds in exactly the wrong timing. The rent being like the coupon, there was nothing that the coupon was going to do to make up for the mark that the bond manager was going to have to take on the principal loss. And that's why you lost money on your ETF last year, because most ETFs are duration fixed. Now, let me know down below if that didn't make sense, but I am going to move on to how should you think about this next year. Now, figuring out what to do next is a tough call that you will probably want to think through, talk to your smartest friends about, or discuss with your broker, your family, that sort of thing. I definitely don't have a strong call on this because I am not invested in this instrument. So let's start with the easiest. If you think that rates have stabilized here, maybe you get 1 or 2 more small baby 25 basis point moves throughout the whole year, it'll probably trade like it used to, very normally, more or less. You'll get decent coupon payment, and maybe there is nothing to do here. Now, if you think that the interest rate's going to continue to rise as aggressively as it did this year, then possibly you should consider cash, or alternatively consider moving into bonds themselves where you have the ability to hold it to maturity, and so you're taking a different kind of bet on duration. Now, if you're not sure what it's going to do, because that's why you paid the money manager to do their job, then what you can do to have a good discussion with them is ask them if the ETF they put you in has some kind of scenario analysis that tells you what they anticipate will happen at different interest rates. It's a simple duration risk scenario analysis that any ETF provider should be able to give you on your investment portfolio. From that, you can have a better discussion about what is the right thing to do with your assets and how you want to feel about it. And if all of that kind of bothers you, because that's the last thing you want to do, you can always go into inflation-linked bonds if you're worried about inflation, but you want something super safe for your money. That would be one way to do it. Or again, just hold treasuries, that sort of thing, outright. Now, this is a very personal decision, so I am again going to say this is not investment advice, but hopefully that elucidates what has been confusing otherwise. Now, that's all I have prepared for this episode. If you have questions, if you have other ways that you would clarify it, stick it down in the comments below. I love that. It's really fun for me to hear what people are thinking. Like, share, comment, or subscribe. And good luck with your investments this year.